Good morning, Amyr.
Good morning, Simon. How are you?
I'm very well, thank you. Very well indeed.
Good, good. So we're here for another fireside chat.
We are indeed. As we sit here, it's Monday, the 15th of February. And we were just having a look at the markets recently. We're just reminding ourselves as to what can often happen in the short term and trying to put it into a little bit of perspective.
Absolutely. As you said there, Simon, sort of February the 15th, in the middle of, well, what might turn out to be the middle of lockdown number 3. And I think whilst people have seen a recovery in their portfolio from those really awful early days of the pandemic on the global stock markets, everybody's just nervous and they're starting to think, gosh, what next? What do I need to look out for next? And we're here to perhaps just to try to add some perspective to why the what next might not be so important and might not be so infrequent as people maybe think it is either.
No, but because this is in many ways, it's a different flavour of exactly the same thing, things that we see year in, year out. So what I was going to do is just share my screen for a second, and I've got a quite interesting little slide I'll pop up, which is just, can you see that okay?
Yep.
And what I'll do is I'll just make that hopefully full screen. It's wanting to play ball. There we go. So if we look at the lines, stating the blindingly obvious, because anyone can read the details at the bottom, but the red, rather volatile line is the FTSE All-Share, which of course is an index of all 647? Not quite sure the number, 647, 643 companies that are listed on the UK market. The blue line is our 50% model portfolio. Now, clearly we have a number of portfolios, some of which take more investment risk, some take less investment risk. That's maybe a subject for another day, but this is kind of the middle of the road on the scale of 1 to 10, number 5, slap bang in the middle.
That's it. And look, I guess for our viewers at the moment, just think about how you were thinking with your own portfolio when you were there at the beginning of that graph around January of 2020. Happy days. Perhaps you had all these plans, all these goals for the year of 2020.
We all had lots of plans. We all had lots of goals.
Absolutely. And then within that sort of first quarter of the year, you would have experienced a ride that is either close to our portfolio, or if you were exposed sort of nakedly to the stock market without any investment strategy in there, you would have seen a drop much more akin to the red line there. So it's all about understanding that drop, that decline, in the context of what declines have given us over many, many years in the market.
It is, and indeed, when we're talking about percentages, as we know, Amyr, when a client's portfolio is increasing in value, or in my portfolio is increasing in value, we look at it generally as a percentage. Oh, look, it's gone up by 5% this year, 6% this year. Hasn't it done well? When it drops, yes, that line is saying at one point in time, it was minus 35%. But mentally, very few people think of it in this cold, clinical way. Actually, if they've got £100,000 invested, that's now just dropped by 35,000. If they've got £1 million invested, that's just now dropped by £350,000 of hard-earned money. And so this is an emotional time, as we know, and we work with clients to avoid the panic.
That's exactly it, because there's a very, very big difference to a client's overall successful financial journey between a loss that they can see on paper or on a screen versus a loss that they actually crystallize by taking a knee-jerk reaction to a temporary downfall, as we've seen in that graph there. And that's what we help people avoid, is making knee-jerk reactions when, in effect, we know that those sudden drops in the market are actually a lot more common than people give credit to. And history has shown us that they've all been temporary.
Absolutely. But as we know, we were discussing late last year, the numbers in terms of the amount of money that flew out of the stock market. There were literally, was it billions or trillions? I can't remember the number you quoted from the US stock market, where towards end of February, March, April, huge amounts of money flew out. And this was, in fact, folks just panicking and selling and thinking, I can't afford to take any more of a loss. And of course, what they then did was to do exactly that. In fact, they crystallized their loss. Whereas we now know, And this is the benefit of hindsight, of course. If you just hang in there, if you have a financial plan that's in place, if you have provision for your short-term requirements, you must sit tight. And yes, it feels uncomfortable, but the markets will recover.
Indeed. And Simon, that's again the beauty of working with a financial planner, is having a framework in place that gives you as the client the luxury of being able to think like that. So for our listeners who perhaps haven't watched any of our other videos, check out the video where Simon and I are talking about the concept of the 3 buckets. Because really your investment portfolio is sitting in what we call bucket number 3. That is those are funds that are earmarked for the long term, for 5 years plus.
Yep.
So there should be no need for you to access those funds in the short term. There should be provision for short-term capital income requirements and for medium-term capital and income requirements. And that avoids this business of crystallizing, of actually doing something wrong with the portfolio when, not if, when it goes down.
Absolutely. So let's put this in context, shall we? Let's just scroll through, because I've got a couple of slides here that just show a little bit of history. Now, as the slide says, this is a history of market ups and downs. It's actually the American markets, because the Americans generally have better data or longer term data than we do. So this is the S&P 500, which is the 500 largest companies on the US market. And we can see that over towards the left-hand side, 1928 to 31, the Great Depression. We can also see around the Second World War, we've got the oil crisis. We've got, if we go from where we are now, this 51% was the banking crisis, which we all tend to remember. I remember it very clearly because it's the last time I had really scared clients look at me. But prior to that, of course, we have this little item here folks tend to forget about, the dot-com crisis.
Absolutely. And all of these ups and downs that folks can see on the screen there, that just shows that those periods of positive market gains in aggregate, they're overweight compared to those shorter periods of market declines, which is to say this: there is a lot more value in investing in a way that allows you to stay invested and mop up those returns from those blue lines over time, than there is in trying to guess when that next red line might happen.
Exactly, because as we know, the age-old saying, it's not timing the market, it's time in the market, which is in fact is a beautiful segue for our next slide, which just shows us, in fact, this is the growth of a pound. This is the MSCI World Index. So this is an index of all global equities. And this simply shows if you'd invested a pound back in 1970, that would now be worth £125. And during that time, we've clearly gone through all these crises that we've discussed. In fact, it's rather nice that this slide reminds us of most of them, because most of us have forgotten the majority of them. Now, I remember very clearly Black Monday, because I, in fact, had started working for an investment company in very late December '86. So there I was at my desk when Black Monday happened. And on that day, it seemed absolutely catastrophic. But by the end of the year, the market had fully recovered. Similar, in fact, to this global pandemic.
And I think that's the biggest lesson that we can draw from a slide like this, Simon, is there always is a reason behind an economic crisis. And sometimes that is an economic or a financial reason. And sometimes, like we've seen last year, that's actually a domino effect from a health crisis that the whole world is going through with this coronavirus pandemic. But the bottom line is this, is if you can invest in a way that allows you to stay invested in the market over time, you can see here that £1 or that £100,000 or that £1 million, whatever it is that you're investing, it does grow over time. And it grows over time because this word that Simon and I have been using in this video, index, we've talked about the MSCI World Index, the S&P 500 Index, the FTSE Index. That is actually an aggregate. It's a way of measuring all of these companies, all of these amazing companies, some of the most well-resourced, best financed companies around the world that are continuously trying to develop new products, new services, some of which we're seeing now, these biopharma companies now are developing the vaccines, which we're all eventually going to take for coronavirus. All of that is progress. So what we're seeing in this chart is if you can invest in a broadly diversified portfolio over a long period of time, yes, there will be crises along the way. But if you can hold steady, because that money is invested for the long term, you will benefit from that continuous progress, that continuous human ingenuity playing out in the form of new products and new services, which we all benefit from as well.
Yes. Had we even heard of Zoom a year ago? Had we even heard of it? So this also segues on to our beautiful little slide on behavioral finance. And it does sum up typically, or how many folks approach the market. And I would sum it up with, they'll often sit there watching the market increase. And then there's a certain degree of, I'd like a little bit of that, please. They invest into the market. There's a certain degree of euphoria to start off with, but then the market drops. And then there's a certain degree of nervousness and there's concern. And as we show here, there's a certain degree of panic. And then finally you sell. And what then happens is that the market increases again, but it increases without you. And so, as we said before, it is about staying invested. It's taking the amount of risk that is required for the investment return that you need to get to the end of your days without running out of money. And it's understanding, by taking that level of risk, the level of volatility that you will experience as part of that journey, because you will experience a level of volatility from investments. Anything, if you want to return above and beyond cash, you will see short-term volatility. It goes with the game.
Absolutely. And seeing a slide like this, Simon, for our viewers who perhaps don't work with either us or with any other financial planner at the moment, they are sort of DIYing their investments. I think it's important for them to maybe take a screenshot of this slide and to try to recognize in themselves how they are feeling in their own investment journey. I think this is absolutely illuminating when you see that actually when the market is going up, you don't necessarily need to be giving yourself a pat on the back and being thrilled about the returns you're getting. After all, it's the global investment markets. It's all of these companies, all of these products and services that are being sold around the world that are giving you your return, not your particular investment strategy or any sort of golden touch fund manager. So equally, when things are going down, don't just look at that statement or that graph on the screen that is showing your portfolio value going down. Revert back to your financial plan. Remind yourself of the stress testing that perhaps you've had the opportunity to do beforehand, and that will be able to inform you whether there really is any need to fear or to panic. You might not be happy about a minus 10% or a minus 15% decline, but that doesn't mean you need to necessarily panic or fear anything more so than knowing that it really is, if history is our guide, a temporary decline.
Indeed, and I can actually guarantee, having worked through a number of financial crises, including the banking crisis, I know the client isn't happy when we meet up. I know the client is often scared. But actually, that is why we go through the whole process beforehand and we put it in context. We explain what sort of volatility they may experience along the way to put that in context. And that, I think, leads on to the last slide for today, which, oh no, it's the penultimate slide. I apologize. This is, well, missing just a few days can be expensive, as the slide says. If you're trying to time the market and you're in and out of the market, and the return on the American S&P index 1990 through to 2019, you would have received from an initial investment of just $1,000, you would have received, or your portfolio would have been worth at the end of 2019, $17,000. However, had you just missed the best one day of performance during that time, one single solitary day, it would have cost you about $2,000. Had you missed the best 5 days, 15 days, 25 days? So that is the problem with trying to time the market. You can often miss out on that single day that spikes a recovery. Apologies, Amyr, you were going to say.
No, not at all, Simon. I think this slide sums it up really nicely. It's a fruitless exercise to be trying to time the market. I mean, we're privileged to be working with people who are far too busy and have far more interesting things in their life to do than watching a screen on some sort of day trading platform. And I'm sure that's the same for our viewers who are watching this video who aren't clients of ours, or else you wouldn't be probably searching for this sort of information anyway. And I can assure you that if you take nothing else from this little chat between Simon and I, it's the importance of having bucket number 3 in your 3 buckets invested with long-term thinking. That's what allows you to mop up those best days over time as they arise. And that's what enables you to have a portfolio or portfolio of funds, of money invested for the long term, knowing that your short-term and your medium-term requirements are catered for in a different manner than what your invested funds are aimed for.
Indeed, which finally leads on to the final slide, which was we try to put into context the value of working with a financial advisor, because, you know, can we demonstrate to a client in financial terms, you know, the value of peace of mind? Can we value in absolute terms avoiding awful mistakes like selling at the bottom of the market? So here's just a list that viewers will be able to just sort of have a little look through and draw their own conclusions.
Absolutely. And you know what, for our viewers who have stuck with us so far throughout this video, only you can add a number to that added value. And if you do think that there is value in having a conversation with us about any of those metrics that you will judge as value to you, feel free to pick up the phone and give us a call or send us an email. We're only too happy to have an initial conversation and understand your requirements and see if our services would be a good fit.
We'd be delighted to do so. And the number, as always, will be at the bottom of this recording.
Absolutely.
Well, on that note, I'll say goodbye, Amyr. I'll look forward to speaking to you anon. I think we've come to a nice end, and I look forward to discussing topics with you in the short or near future.
See you next time, Simon.
Bye-bye.